In this presentation, we're going to enter the beginning balance for our bank account so that we can reconcile. In other words, we've entered the data or the activity from the bank feeds, but oftentimes there's going to be that beginning balance. We're going to have to enter that beginning balance as well. Get ready to go, because when it comes to business cloud accounting, Sage is all the rage. Here we are in our Get Great Guitars Company summary page within Sage. We're going to be opening up our balance sheet over here by going to the report drop down and opening up that balance sheet, our favorite report, our financial statement report. Then we're going to go up top. We're going to right click on that balance sheet and we're going to duplicate that tab so we have the balance sheet to the right and another tab to the left. I don't think we need the income statement now, so I'm just going to check the dates. We're in 2020. That's the current period that we'll be working with our practice problem. So now if we scroll down and we take a look at what we have, we've got the 84,917 in our checking account with regards to Sage. Now, the question is that what's in the bank account as of that point in time? Considering the fact that we've been relying completely on the bank, you would think it would, but there's going to be a bit of a problem on this first month of transaction. If I go back over to our bank account, this is our mock bank account for March here, and we have our ending balance of the 190,728. And so note in our Sage account over here, it's as of 12/31, but there's nothing in there after March, so we could just put this to March 20th, 2020, March 31st, 2020, and we would have the same balance. So as of that point in time, we have a different balance. Why is that the case? Because we've entered all the information in our bank feeds from the bank, right? All the bank feed information or the transactions. However, we entered that and did not enter the beginning balance. We didn't include the beginning balance, and that's often the case when we start a new file in a new software. Typically, the first month can be a problem because oftentimes we're taking the information from a prior software possibly. We already have money in the bank then. We're not going to be putting all the data back for the whole time that we've been in business. We're just going to cut off and say, hey, as of this point forward, this is the data that's going to be in there. Therefore, we're going to have to enter the beginning balance, as of that beginning cutoff. Or if we start a new business, it's quite often the case where someone will put money into the checking account before they start doing the business transactions. And again, we already have money in the business account. So we're going to have to add that to the system so that we can reconcile. Now note that since we're on a cash basis system, we're basically dependent on the bank feeds. When we do a reconciliation, there's going to be no difference between the ending balance. There should be no difference between the ending balance as of a given point in time and what we have in the system, because we took the information directly from the bank. And that's kind of what we're doing on a cash basis system. Not only a cash basis system, but one that is dependent on the bank, waiting until things clear the bank in order for us to create our books with it. That's different than a full service accounting system or even a cash basis system, in which case we typically put the information into the books and then reconcile them to the bank. And if that were the case, we would have a timing difference. Timing differences would be the reconciliation, meaning especially when we write checks, we would write a check. We know about the check being written. We know it went out, but the bank doesn't know about it until the future. And so until that check is cleared, we have a reconciling difference. We know about it, the bank doesn't. We're actually right, the bank doesn't know about it yet. We have that reconciling difference. If we're dependent on the bank to make our books, then we don't have that reconciling difference, because we're going to wait till the check basically clears before we record it on our side. And if we're more dependent on electronic transfers, then there shouldn't be as much of a timing difference as well. But just keep that in mind when you think about the bank reconciliation. It's not going to be the same if you're relying on the bank to make your books, as opposed to if you're doing the books separately. There will be reconciliation items. But in our case, the difference is going to be, you would think, the 105,811 here. So let's just double check that, pulling out the old trusty calculator. The ending balance here is the 190,728.54. And if we go on over to our amount on our statement here, I'm going to say minus the 84917. It's the 105,811.54 that we have to add. So we have to add that. It didn't come through with the bank feeds because it's the beginning balance. So how are we going to add that? We're gonna add it, increase in the checking account. So we're gonna have to add it in that format. Where's the other side gonna go? It could have came. We got to think about, well, where did it come from? It could have came from two different places. One, it could have came from income we made in the past prior to our cutoff date. In this case, March. It might have happened in the past prior to this. And therefore, if this is our cutoff date that we're first starting our business as of in this system, it should be in retained earnings, right? Or some kind of equity account, the rollover retained earnings that are going to roll over, not an income statement account at this point, right? It was income before that rolled into retained earnings. Or It might be a result of us putting the money in as like a contribution to the business to spend on the startup costs or something like that. In that case, again, it should be part of equity, just possibly a separate equity account. In that case, possibly go into the contributions. So in our example problem, we'll put it to the contributions, but just note that the bottom line is it should go to the equity account if it's part of retained earnings over the periods in the past. It should go to equity in retained earnings. If it's part of the a contribution for a new business, then you might want to put it into equity owner. The point is, though, it doesn't go into the income statement in the current time period that you'll be working with. All right. So then we're going to go back to the prior tab to do this. So within the prior tab, we want to be adding. So I'm going to go to the plus button over on the right. We got the red plus button. I'm going to go into the payments and receipts. And I'm going to say that we're going to have a customer receipt. Now, this isn't going to be coming from a customer, but this is, I think, the easiest way to get into this form. So I'm going to go into the customer receipts. And then up top, you'll note you have a customer receipt, other receipts, and vendor refund. This is money coming in. These are basically the types of forms for money coming in to the company. I'm going to say it's not a customer. It's going to be other receipts. So I'm going to go to other receipts. We're going to have a beginning balance. I don't know who the customer is. It came from possibly multiple sources, or I'm going to assume it came from us, the owner, at some period prior to the starting point of our business here. So paid in the bank, I'm going to say this is going to go into the old checking account. The method I'm going to select will be the electronic. I'm going to put this in there as of, I think, March. Let's just go March 1st. And then the amount is going to be that 105,811.54. So 105,811.54, that's going to be this amount, 105,811.54, the beginning balance on our statement over here. And then the other side is not going to be going to an income type of account. We want it to go to that equity type of account. So the ledger account is going to be some type of equity. So it was like contributions. Yeah, owner's contributions. It's in the 3920. So there's the amount. And there it is. So what's going to happen when we record this? Checking account's going to be going up, of course, by the 105,811.54. No effect on the income statement. Other side going directly to the equity section, in this case to the owner's contribution. Let's go ahead and save it and check it out. So we'll go ahead and save that. Make sure no red things come up saying, hey, you did something messed up. So there we have this. And then if I go back over to the balance sheet, and we can go to the balance sheet here, and I could have checked the number right there because they showed me the balance in the checking account. But I'm going to go up top and I'm going to recalculate the balance sheet. So now we're at the 190,728.54. So now we're at the 190,728.54, which is our ending balance, would be our checking account balance as of all the, we've entered all the data up to this point, and that's where we are. Notice it matches out because, again, we're taking this information directly from the bank. Therefore, at this point in time, the reconciliation process should be fairly easy. It would be still advantageous to do a bank reconciliation, just comparing our numbers to the bank. But once we do those, we shouldn't have any reconciling items if we're dependent on the bank to make our books. So it will then be a practice to reconcile to the bank, just to make sure that we haven't double entered anything or that we have kind of omitted anything. Let's take a look at the other side, the other account that's affected over here before we stop. I'm gonna stop there. We didn't look at the other side. It's gonna be down here in the contribution, so it's in the equity section. Again, we put it into the contributions, and if it was income or income in the past, you may have put it into retained earnings or something down here. But the point is, it's going to be in an equity type of account, not affecting the income statement. So that's going to be it for now. Let's get out of here.